It almost feels to me like the markets are giving the Trump administration some wiggle room. Because, there's a bid under this market, and I feel like unless it goes horribly wrong and we find out that, no, guess what, there's no tax reform coming this year, there's a bid under the market.
Oh, absolutely. And the markets have been rewarded
right.
for betting on that. We've had a significant rally. And the story of the last few years is don't bet against this market. There's a lot of liquidity on the sideline.
Well, and I agree with you, Mohamed, too, that, we're in the seventh inning stretch of an expansion. We're in the late stages of an economic expansion. We have a friendly set of fiscal policies coming. Whether, the market's up 5% this year or it's off later in the year, I think is almost irrelevant for investors. If you look out over the course of the next 2 to 3 years, I think that stocks are going to continue to perform. And we might have to take some noise, especially with geopolitical risk. Who knows what's going to happen with North Korea? Who knows what will happen in Syria? So at any moment, we could have a setback because of a shock that's extraneous to the economic data. But still, at the longer run, Maria, the policies are favorable, and we should be positive.
Well, what do you make of what Mohamed points out, yields? I mean, you're talking about a 10-year at what, 1.7% right now?
10 years at 2.30.
2.30 right now. Still, I mean, okay, so it's ticked up from the lows of 2 weeks ago at 1.7. But you're talking, what is that telling us?
Well, it's basically telling us that, one, that we're not in an inflationary environment, right? That this idea that we had this fear that inflation was going to take off is fading once again. Two, that we're still living in an era of financial repression. Monetary policy, even after the Fed has raised rates 3 times, is still highly accommodative. And it's not in the interest of central banks around the world to see interest rates go up dramatically. So as long as the ECB continues its QE program, as long as Japan continues its QE program, we're going to have a lot of downward pressure on rates, which we've learned the lesson from the last 5 to 7 years, that quantitative easing is good for risk assets, and risk assets go up in price.
Well, what did we hear from the ECB last week? I mean, we were all waiting to hear Mario Draghi say, we're done. I guess we didn't hear that. What do you think?
We heard a contradiction. The first part of his statement was how the economy is improving, how the downside risks are coming down. So he got you ready for saying, and now we're ready to start normalizing.
Step away, right.
But it didn't come. And that, in a way, is what the markets have been conditioned to, is that the ECB, as Scott said, will be supportive. And I think it puts the ECB in a difficult position. I think they are too hesitant. You have to take advantage of windows to normalize, and Europe has a window right now, but they are too hesitant.
How do you position yourself right now for global markets? I guess when you're looking at Europe versus the U.S., it's different. But tell us how you would position yourself or recommend clients position, Scott.
Well, look, I think it is a good time to be long European equities. It's a good time to be long Japanese equities. And we've remained positive on emerging markets even after the election. So, as the commodity prices start to rise with the expansion in Europe and the United States and in China, emerging markets will probably do well. So I think a lot of the markets people have tried to avoid is where you really should be putting your money for the longer term.
I don't think I've ever seen you this bullish. Am I wrong?
Oh, no, I've been pretty bullish since 2008,
No, but I mean, today, from then, from 2009 until you've stayed the same.
That's right.
Bullish.
Pretty much.
Okay.
Right.
What about you, Mohamed? How do you position yourself?
So I would say put fewer dollars at risk, but continue to allocate them to sectors that have lagged. So I agree there's still opportunities in emerging markets, but fewer dollars at risk at this point. I think we're going to have some bumps along the way, and you're going to have more attractive opportunities come in, but continue with the rotation trade.
So the easy money has been made, in your view?
Yeah, we've moved a great deal. And if you look at the Trump rally, we had 3 phases. The heyday, the very big move.
Right after the election.
Till the 3rd week. And then the 3rd week of December till election day, a wait and see with rotation. And then since then, we've seen volatility go up. But we haven't seen another very dramatic move. And I think it's important to realize there are different phases to this impressive Trump rally. Because
now we're waiting on policy. Now we need to get the goods.
That's right. We've been on a sugar high here, a lot of promise. We haven't really seen the delivery yet. But I'm hopeful. I'm hopeful with the announcement of the tax plan last week that we're starting the first steps. And it's going to take a while. Are there opportunities
for infrastructure around an infrastructure plan? I mean, infrastructure type investing. What do you think?
Oh, yes, in bold letters, italics. Absolutely.
That's going to be a big opportunity, you think?
I think that's going to be a big opportunity because I think the Trump administration realizes that you can't do it all or most of it through the public sector. You're going to need private-public partnerships, and there are massive opportunities for public-private partnerships. So yes, there's going to be not only opportunities, but there's massive appetite for long-duration exposure. So I think that is going to be an area of focus.
You agree?
I agree. I think especially the private sector is going to benefit from the infrastructure build. And there are a number of infrastructure ETFs out there that investors can take advantage of. And they've performed very well so far since the election, and I think they'll continue to perform well.
And even, somebody's got to pay for this, right? So, I mean, the banks could actually be in a good position to actually get this business in terms of these private partnerships. Real quick, what do you want to avoid right here? What do you look at and say, you know what, this is either too expensive or not worth the risk or whatever?
Well, I think in general what we're finding out is corporate debt is getting very expensive. Investment-grade bonds are nearly as expensive as they've been in any cycle relative to U.S. Treasuries. And, high yield below investment-grade debt is starting to get very expensive. So those are places, I think, where the risk-reward is you're not being paid.
Thoughts real quick, Mohamed?
Totally agree with Scott.
Oh, okay. Well, we will leave it there. Mohamed El-Erian and Scott Minerd, great to see you both.
Thank you.
Thank you so much, gentlemen, and thank you.